Or not, sorry.
Financial insights to experts. I need to know. Or send us a link to the website and I can get the rest online.
Okay.
This is a show that puts your financial future first. Tune in every Monday from 5:30 p.m. to 5:45 p.m. for this insightful wealth management program, because informed decisions.
So you just want to trickle once it comes in.
On Classic FM 97.3. Your money should work as hard as you do.
That's right, it certainly should, and that's why we bring you this show at 5:30 every Monday here on Classic FM 97.3. Welcome to today's edition of Wealth Management and You here on Classic FM. My name is Chico. Joining me in the studio, Raphael. Emenyonu. Raphael, how are you doing today?
Good. Yourself?
Yes, all's good in the hood.
You had a good weekend?
It was all right. I had plenty of rest.
Fantastic.
Our topic today is how to select the right mutual funds. So stick around and you'll find out. If you cast your mind back to last week, we gave 5 lucky winners the opportunity to win free device insurance courtesy Skrilla Technologies Limited. The good news is we come back this week with more giveaways courtesy Skrilla Technologies Limited. Now I'm going to give you some details about Skrilla Technologies Limited in the course of the show. But here's your question, because you can actually find out unless you've been living under a rock. You'll be able to answer the question up front. We'll be announcing winners at the end of today's show. What does... I'm not going to ask that question. Let me do it. I'm asking a different... That's way too easy. What problem does Skrilla help solve for smartphone owners? What problem does Skrilla help solve for smartphone owners? And I can tell you that Skrilla helped me solve that problem. That's right. So I'm beaming from ear to ear because that problem was solved for me. Now that's my question. You can send your answers to us via WhatsApp on 0704 1001 973. That's WhatsApp on 0704 1001 973. What problem does Skrilla help smartphone owners solve? Remember to add your name to your message. Let's get to today's subject, Raphael. How to select the right mutual funds. Talking mutual funds would be wrong if you didn't answer the question, what are mutual funds? So that if there's anyone listening who's living under a rock, there's always one or two who know exactly what we're talking about.
All right. Mutual funds, pool of funds from different investors, individuals, institutions, high income earners, low income earners, with similar objectives. Now that's very critical. You know, they need to have a similar objective for them to be able to pool their funds together. Now these pooled funds are then passed on to who you call a fund manager.
Yes.
Now that fund manager now invests the money in assets that aligns with these objectives.
Yes.
And then the returns, the gains, the interest, the growth made from this pool of funds is then passed back to those investors. So that's the cycle, right? That's how mutual fund works.
They have it pretty straightforward. You can't possibly have any questions about what a mutual fund is. And now that you know what it is, let's go to something Raphael mentioned here. It says similar objectives. How does one identify those objectives? Are we talking about the levels of risk appetite?
That's correct. That's one of those, right?
Okay.
So the risk appetite, which you can also say is a risk profile,
Yes.
now is one of those objectives. Now, are you a low risk individual? Are you a moderate risk individual? Or are you a high risk individual? This will help you determine the sort of mutual fund that fits your risk profile, right? time horizon is also one of those factors that you need to consider.
Time
horizon,
okay,
is also one of those factors that you need to consider, which means, are you looking at a short-term period, or you're looking at a medium-term period, or you're looking at long-term, right? So if you're low risk, for instance,
yes,
you probably want to settle for a mutual fund that is risk averse, that preserves your capital. You don't want to experience any form of volatility.
yes,
Right, you want your capital preserved, and then you want to earn a decent income on it. If you're a moderate risk individual, you probably want to settle for a mutual fund that you can see when it's growing very slowly, and when it's going to decline as well, because that could affect your capital. It will be very slow as well.
yes,
And then if you're a high risk individual, you might want to settle for a mutual fund that the return is it spikes very quickly. It goes up sharply, and then when it's declining as well, it declines very sharply. And that could affect your capital as well. So you need to understand what your risk appetite is, because that's one of the similar objectives. The second one is the time, which is short term, medium term, and long term, like I mentioned earlier.
okay,
So for short term, maybe you're planning for a 6 months, maybe your vacation is in 6 months and you're trying to put money aside. Maybe you want to pay for your house rent, maybe that is due in a year, and you want to put money aside. Or you're probably putting money aside for the children's school fees, or the goods that you want to buy as a trader. And you're putting money aside as well within the next 6 to 8 months, right? Those are short-term goals. Whatever you want to achieve between 0 to 24 months are short-term goals. Whatever you want to achieve between 24 months, which is 2 years, to 10 years, are medium-term goals. Whatever is above 10 years are long-term goals, right? So if it's short-term, sorry about that. If it's short-term, right, what is important to you is to keep your capital intact. Right? You don't want to gamble with your capital, right? So you keep it intact, and then you earn some decent income. So you can see that is sort of linked to someone that has a low risk appetite, right? So both of them can actually invest in a low risk mutual fund. Right? So someone that has a medium term goal, a medium term time frame, right? Can invest in a balanced mutual fund, along with someone that has a moderate risk, right? And then someone that has a high risk and someone that is looking at long term can both invest in a mutual fund that is focused on the long term, right? Which is mostly the equity type of mutual fund. I think we would also get to those, as the question comes. Another factor is age. Right? So if you're between 24 to 45, it also depends on the community where you grow up. We've talked about how community could impact people's relationship with money. But ideally, what is advised is that between the age of 25 to 45, you should be able to take some risk with your money. So it's advisable that, you invest in the high risk space, right? The long-term mutual fund, because you still have many more years ahead of you, to recoup those losses, if there are losses at all, right? Between the age of 45 to 65, you're expected to have a mix of, moderate risk, or a balanced type of mutual fund, medium term kind of thing between that age, and then at the age of 65, you're expected to then have more low risk investments, because at that age, you're not expected to be taking a lot of risk. All you need to do is to begin to earn from your income, at that age, 65 and above, so you're still 60. So that's also another factor. Faith is also another factor, that help you determine the objectives.
Some people don't want their money to be in certain areas.
So that's another factor to look at. Amount is also another factor. The minimum threshold for the different types of mutual fund is also another factor that could also guide you in taking that decision of where you put your money into.
Now, does the level of risk or one's risk appetite determine returns on investment?
Yes, it does. So the relationship between risk and return is the lower the risk you take, the lower the return. The higher the risk, the higher the return. Now, the risk in this
and this is fixed by someone.
It's it's what you find, in taking those sort of it's the philosophy,
Yes.
So risk in this instance is not necessarily that you're losing money. What it just speaks to is that the moment you're not in control of the money, you've given the money out, you're not in control of it, you should be expecting more premium than someone that has done investment for a shorter period. So what I'm trying to say is, so Chico and I invested in a mutual fund,
Yes.
right? Chico cashed out of that mutual fund after 6 months. I still stayed on for another 6 months.
Yeah.
So it's expected that when I'm exiting that mutual fund, I should make more money.
Yeah.
Chico, right? So, and because I'm spending more time in that fund, anything can actually happen, right? So that risk is what is being measured.
Yeah.
So it's not necessarily that you're going to lose money, but it's just that time factor.
You are exposed longer.
Yeah, that you need to ensure that,
Okay. So you've touched on it, but there are different types of mutual funds.
Absolutely.
Talk us through those.
So the common ones, right? They can be different names. The common one. I start with the faith-based.
Okay.
And that speaks to people that want to protect their religious morals. And you still want to make money.
Yeah.
So you don't want your money invested in breweries, for instance, banks, for instance, because the sort of business they do, they don't have money and they earn interest.
Yeah.
You don't want your money exposed to companies that produce porks.
Yeah.
Hospitality business, because it's against your religious morals. And the interesting thing is that if you look at both Christian morals and Muslims, Islamic morals, they're kind of similar.
Yes.
So
areas where they align.
Yeah. So the faith-based is a type of mutual fund, and it could be suitable for certain objectives as well. The other one is the aggressive kind of mutual fund. So this type of mutual fund invests in aggressive instruments, as the name implies. So equities is one of those asset classes, that those type of mutual funds are exposed to.
That's aggressive.
Yeah.
Okay.
So equities are stocks, right? The stock market is one of those, aggressive asset classes that those sort of mutual funds invest in. So it could be different stocks in different sectors as well, to enjoy the diversification advantage that mutual fund presents. Another type is a low risk mutual fund, which is the most common in Nigeria today, and that's the money market fund. This invest in money market instruments. These are instruments that naturally preserves your capital, right? And it pays you decent income. It's the most common and about the most successful in Nigeria today, and that's because of the nature of our environment. People would rather put their money in instruments that preserves their capital and pays them decent income. So that's suitable for those with low risk appetite, those that are approaching retirement or they're in retirement and they just want to keep everything safe, those that are risk averse generally. The other type is another type is the dollar mutual fund. Now for those that maybe they have dollars just stacked in the bank, it's not earning anything, and they want to hedge against the naira. There are different types of dollar mutual funds in Nigeria today that people can actually invest in. So that's also another type, which is made available. And I think the final one I would like to touch on is the balanced mutual fund.
The balanced mutual fund.
Now, this is suitable for people that we've identified earlier as with moderate risk profile. Those sort of people with medium term goals, medium term horizon.
Yes.
And those sort of people. So the balanced mutual fund is a type that when it's growing, it moves slowly. When it's declining, it declines slowly. But it could affect your capital. But the interesting thing is that you see the movement because it's very slow, not as aggressive as the aggressive type. So it doesn't move quickly. It moves slowly and then it declines slowly as well. So that's a balanced mutual fund. It could invest in fixed income instruments, which are bonds and money market instruments. It could invest in stocks.
Okay.
And it could invest in real estate. So if a particular asset class isn't doing well, the other asset classes are not likely to follow that direction. You know, so that's the benefit of that type of mutual fund. So those are the key categories, you know, of the different types.
Thank you very much. In case you just tuned in, we're discussing today how to select the right mutual funds. That's our topic on today's edition of Wealth Management and You. And let's not forget, I did ask a question at the beginning of the show. I do see some answers coming through, and I got at least one winner from what I can see. But what are the advantages of mutual funds, Raphael?
Quite a number. I'd mentioned earlier that diversification is one of those. In an investment world, one of the things that is being preached is diversification. And mutual fund offers that seamlessly, because what it does is that it doesn't invest in, even if it's investing in one type of asset class, it invests in different areas of that asset class. Just like stocks, for instance, it invests in different stocks, different companies in different sectors. So that if a particular stock isn't doing well, other stocks in that sector will follow that direction. Yes. If a particular sector is not doing well, other sectors are not likely to follow that direction. So diversification is one of those advantages. The other advantage is that it depends on how you also specify your mandate. You know, you could also enjoy the power of compounding, which is earning interest on interest. So on money market fund, for instance, that pays interest periodically, you can give a mandate, you know, for that interest to be compounded.
Yes.
Right. On stock related mutual funds as well, that pays dividend, you can give a mandate that dividend should be compounded. So you're using the same interest from the same capital to buy more units, right, of that mutual fund. Because I didn't mention this at the beginning, what you own in a mutual fund are units. And what you keep acquiring as you buy more, as you invest more in it, are units as well. You know, so the more your units, the more you're likely to earn from that fund. It's suitable for small savers. So in a mutual fund, money market, for instance, I think the lowest you can invest is 1,000 naira. And today, I think a money market.
So do those mutual funds where you can invest 1,000 naira?
Oh yeah, you have students that are investing as well, and because it's open to a large pool of people, you have institutions that are investing billions as well. You have individuals that are investing hundreds of millions, and then you're also investing your 1,000, right? So everything pulled together, you know, is what is then used to ensure that you earn a decent interest.
Yes.
Right. And that is cuts across everybody. But the more units you have, which those in billions and millions will be able to acquire, you know, compared to the other person, pays you more, right? And it also gives you room to add more to your savings, you know, at your convenience. You know, so it's suitable for small savers, so you can benefit as much as what the big savers would benefit. It provides liquidity. Imagine you're investing in a mutual fund that has real estate as part of it. If you're a direct investor in real estate, you might not be able to sell if you want to sell today. But from the mutual fund, you can easily exit. You know, when you need money, you can make withdrawals when you need money. So that's another advantage that it provides. It's convenient, it's flexible. You can start anytime and you can exit anytime that you want to. So you have that free entry, free exit, you know, as well. It's professionally managed. So you don't need to bother yourself about
and
regulated as well. So you don't need to bother yourself about where you want to put your money, what assets should you be buying. You're giving it to a fund manager, which is what they do 24/7. You know, so rest assured that they'll be able to make the right decision for you, and they'll be able to
certainly a better decision than you might be able to make for yourself, because they're experts.
Yeah, because they're experts, you know, and because you have your daily job. It helps you to pay more attention to your daily job, make more money, and then let them protect your savings for you.
Brilliant stuff. Let's remind you that we are giving away five phone insurance, not phone, but device insurance, courtesy of Skrilla Technologies on today's show. And my dear sister Miles is coming in. We'll announce the winners very shortly. So if you fancy answering the question Now's the time. Please don't wait till the end of the show, and then send a message in and have a go at me when your response doesn't count. The question that I asked earlier at the beginning is, what problem does Squella help solve for smartphone owners? If you know the answer, send me a WhatsApp message on 0704 1001 973. Could be you that is one of 5 lucky winners on today's show. Before we wrap this up, Raphael, let's have an overview of mutual funds, starting with what they are and how it all works, and how one can get on that train right now.
Yeah. Okay, so we had said earlier that mutual funds are pool of funds from different investors, individuals, institutions, high income earners, low income earners. It's just a way to keep money away. It doesn't stop you from doing your business. It doesn't stop you from earning 200% in your business. It's just for you to be able to set something aside and ensure that, you're building a portfolio on the side, right? And this pool of funds is then passed on to a fund manager who then invests the money in assets that are aligned with those objectives of those investors that have put money together.
Yes.
And then the returns that are earned on those investments are then passed back to the investor. So it's similar to what people do in the office that they call ajo or esusu.
Yes.
The only difference is just that one is not given to a fund manager, and you're going back to pick up the same capital that you put together. But in this instance, there's a growth on it.
Yes.
When you go back to it. So that's the advantage over the ajo and the esusu, but it's similar to it. So it's a pool of fund, but it's invested in this instance, and you're making some money on it, and then it's passed on to the investors. We talked about what those
and then so is there always a payout, even if you're not asking for to pull any money?
Yeah, so most of them are structured to ensure that there's payouts.
Okay.
So like the money market fund, some pays monthly, some quarterly, like the equity related one, some pay twice a year, some pay once a year. So it's structured to ensure that something is paid out, so that you can see progress.
Yes.
And we said the similar objectives, factors that could determine those objectives: age, faith, risk profile, time horizon, and the amount, that is the minimum threshold to be invested in those funds. We talked about the different types as well. We talked about the faith-based. We talked about the aggressive type, which is mostly equity related. We talked about the balanced mutual funds, which is suitable for people with moderate risk profile.
Yes.
We talked about the dollar-denominated mutual fund as well, which is suitable for those that want to hedge against the naira, that have dollars, stacked in the bank, and they can make the best use of it. The benefits of the mutual fund as well, we said it's suitable for small savers. Diversification is one of the advantages because it spreads the money across different asset classes.
Yes.
And even if it's one asset class, it spreads it across different areas of that asset class, so that if one area isn't doing well, other areas are unlikely to follow in that direction. Compounding is also one of the benefits, so that when you're earning this payout, you can decide to leave it to buy additional units in the fund. It's professionally managed, so the people that are behind it is what they do 24/7, so they're not distracted, so you can focus on your daily job, and they can continue to invest for you. We said it's suitable for small savers, and it's liquid, and then it's convenient, and it's flexible as well.
Yes. So there you have it. Money market mutual funds for dummies. Like me. Okay. Now, let's see. Do you have any right answers before you go? James Carr says it helps to solve unexpected smartphone repair costs, like shattered screen. I'm going to take that answer. Yeah, so we'll send that on. In a manner of speaking. Victoria says Chico, it's essentially smartphone insurance against damage. I like your answer too, Victoria. We'll take that. Scrolling through just to see if we have any other right answer. No.
Also, it's just two we're giving away.
Yes, it's two we're giving away today. I'll tell you what. Why don't you log on to just search Skrilla Technologies Limited and get information so that next Monday during wealth management and you'll be able to answer the questions more intelligently. So congratulations to Victoria and what was the other name I mentioned? Got Victoria and I have James Carr, our two winners on today's show. Do you want to say your congratulations to them?
Congratulations, Carl and Victoria. For others, do join us next week, Monday, like Chico mentioned, and then we'll be doing more giveaway.
Wealth Management and You comes your way at 5:30 every Monday on Classic FM 97.3. Please make it a date. It's really important, especially as we celebrated Father's Day yesterday. Fathers typically are the head of the house, the breadwinner of the house.
Pillar.
And if you're not creating wealth and handling biz, then everything else and everyone else suffers. One of the ways we wish to do that is to invest in mutual funds, as explained by Raphael on today's show. So make sure you're making smart money decisions and managing your wealth properly. Yes?
That's correct. That's correct. And if you've missed any of our episodes, please check out our YouTube channel, Wealth Management and you'll be able to watch all the previous episodes, including today's episodes. And if you want to invest in mutual funds, you can check out ARM.